everybody. The moderator here for the second panel, this panel is going to discuss why we need a public bank, if it's not clear already, in Colorado. And the moderator for this panel is Dennis Gallagher, City Auditor for Denver. And he's having a ball trying to make his hometown better off than he found it. You probably all know him. He served 4 years in Colorado House and 20 years in the Senate, and 16 years on the State Legislative Audit Committee. He has a BA from Regis in English Literature and Latin and Greek, and an MA from Catholic University of America in Speech, and a J.K. Mullins Scholar. He also taught at Regis University since 1967, so please welcome Dennis Gallagher.
Enjoy to be with you and to be talking about banks and banking. You're getting sort of, as Thomas Aquinas says, of the soul when it's born, tabula rasa. You're getting a tabula rasa with me. I don't know much about this. I know Mike O'Neill over there, and he tries to explain it to me, but my grandfather was always suspicious of banks, and I remember him saying something like, whenever he went in a bank, he wanted to go talk to the banker and smell the banker's breath and look in the banker's eye to see if he was telling the truth. I'm not sure how that ever turned out, but I'm quoting here from Marshall McLuhan, a book called Understanding Media, a wonderful book, which I hope you'll all at least look it up. And he's got a wonderful chapter on money. And listen to what he says. Money, the poor man's credit card is the subtitle. Isn't that becoming the truth? Yeah. The other day I was in the store, and I tried to pay cash, and they wanted to see my Colorado driver's license. It's interesting how this is going, isn't it? And then there's all kinds of new money that are coming forward. And he says here in the second sentence of his chapter on money, some analysts derive money from the infantile impulse to play with feces. And another advisor said that in particular, this famous expert, Ferenczi, sounds Hungarian, calls money nothing other than odorless, dehydrated filth that has been made to shine. So I don't know. I don't know whether that helps us out or not, but it's a great little chapter, and I thought you might enjoy him commenting on that. Marshall McLuhan, McLuhan, a wonderful scholar. He taught at St. Louis University, and he was the medium is the message is his famous quote. And the reason I got to know him is he taught at St. Louis U, but the Jesuits at Regis had a little mountain retreat where they would invite him to come and stay at the retreat, and then he would lecture at Regis during the week. And so that's how we got to know him. And I'm real pleased to open this session. Our first speaker is Roshan Bliss, a BA in Philosophy and Religious Studies from Purdue, and to study for a master's conflict resolution and intercultural communication. He was forced to drop school in 2012 to avoid drowning in student debt. We know a lot of people like that, don't we? And out of a desire to be more engaged in social movement that he cares about, he has since become active as a youth organizer involved in several areas, political activism locally, nationally, and internationally, building with the national and international student movement. He's passionate about creating real power for young people through democratizing their schools and their communities. So, Roshan, do you want to take the microphone?
Hi, everyone. Thank you for that introduction. Really appreciate it, Mr. Gallagher. And my name is Roshan. I am so pleased and honored to be here. I really appreciate the invitation to come speak. So yeah, I was asked to share a few thoughts on the situation of student debts in our country and the relevance to the issue of public banking, and there are a lot of really important connections. not to just give the whole thing away, but I mean, it's really easy if people who are collecting, I mean, so I guess I won't go that fast. I'll back up a little bit. So just to kind of give some background on the situation of student debt in this country, people in this country collectively owe $1.2 trillion, with a T, to various financial institutions because they took out loans to try to get an education. There are over $40 million, or 40 million people, that is, who share that $1.2 trillion in debt. And many of those people are young people. A huge swath of it, the majority is people who have been out of college for years now and who are between the ages of 30 to 45. Then the next biggest chunk is people in my age range who are under 30. There are also huge proportions of that 40 million people who are over the age of 50 because so many parents and grandparents have borrowed against their homes, against their retirements, to try to afford, help their children go to school. And I think that it's really imperative for us to think about this as a moral issue. Our country is the most advanced, developed country in the history of humanity. We have access to more information and knowledge than any time in human history. And in this country, it is nearly impossible, unless you're already wealthy, to have your share, to access an education and have your share of that knowledge and of that development without falling into almost crippling debt. And this is a moral issue because this is something that we do to our young people in full knowledge of what's happening and with the ability to have the situation be otherwise. So that's why it is an important moral issue that not only are we vastly mismanaging the wealth and resources of this most developed nation in human history, but we're also setting up a situation wherein our parents and grandparents are profiting off of the pain of their children and grandchildren. Like it was said in my introduction, I had to drop out of my master's degree in conflict resolution. Lots of people told me, oh, what a wonderful pursuits. We really need lots of that. You'll have a wonderful job market. But I was attending the University of Denver, which charges a fairly unconscionable amount of money for a year. And it's, DU unfortunately is not special in being almost inaccessible to the average person in terms of the financial ability without falling into debt. So one of the biggest problems that I want to point out here, and how much time do I have? You've got 5 more minutes. 5 more minutes, okay. So one of the things that I want to make sure that we address is that there is a huge problem in this country with the amount of young people and just people in general who can't afford their college tuition, and so they have to take out debt, but then that debt becomes its own problem, right? And there are lots and lots of ways that the $1.2 trillion that is being paid interest on to private entities largely like Sallie Mae, like Wells Fargo is the number 2 debt holder in the country, and that those resources, the way that we have structured it, is the result of corporate influence. Sallie Mae is the number 1 student loan debt collector. They have been in that position. They are a private contractor for the federal governments, they contract with the Department of Education. And in the between 1998 and 2012, Sallie Mae has spent, I'm going to get the number wrong, but it was something like $23 million on lobbying the federal government to change the conditions of their loans, our loan program that we have in the Department of Education runs, to make it more favorable to them, essentially. And they have been in lots of ways lobbying for their own ability to continue profiting off of this massive amount of money, the debt that they service in our country. And the core problem here is that the people who are in charge of managing the student debt that our country has have a profit incentive. They are not in this to help young people. Sallie Mae is not a company that was founded on the vision of empowering America's young people to attain an education. It was founded because someone said, we can make money in this gig. And let's just be really, really clear. They are a for-profit company that exists to earn their shareholders' money. They are legally obligated to do that because that is the legal obligation of corporations, to make money for their shareholders. More money than last year. And so the really obvious way to change, and so Sallie Mae in this situation as this kind of profit-seeking entity has been using its influence to change policies to make it so that they are more focused on collecting their debt, collecting the debt that is owed on the student loans that they manage, than they are on helping people who are having trouble paying on those debts. I was just reading a report on the way over here that's really great that I can definitely share later, that was showing that the public-private contract that exists between Sallie Mae actually incentivizes, and the Department of Education, actually incentivizes all of, Sallie Mae is just the biggest one. There are multiple smaller private entities that are also in the same position of Sallie Mae as servicing student loans. And they actually have bigger incentives to collect money than they do to actually put in the labor-intensive work of helping rearrange payment plans and service people who have distressed loans, as they call them, people who are in default. But the fact of the matter is, Sallie Mae invests so much money and effort into collecting the debt that people owe them, yet at the same time, for the last 5 years, Sallie Mae has owed the Department of Education over $22 million. Sallie Mae, the debt collector, is in massive debt to the public education system, and it has not made a single payment in over 5 years. And our government does not force it to. If Sallie Mae were a student, Sallie Mae would be in default. Sallie Mae would have had a huge fee applied to it as soon as it went into default, just as a penalty. And then its interest rates would have gone up. The average interest rate is 6.8% on student loans that are unsubsidized. Their interest rate would have gone up to possibly higher than 25%. The maximum, some of the highest interest rates are 40%. And Sallie Mae has been sitting here on an interest-free debt with to our nation that it has not paid for 5 years, while it hounds young people and old people alike to pay back the debt that they owe and they are collecting the interest on. So obviously, there's a misalignment of incentives for what we want and need in terms of being able to finance our education system, which should have been free in the first place. It's just not even a conversation we can really get into today. But given the fact that it's not, a public bank that actually existed to benefit and serve the public and not to make profit would be doing so much better at helping those people who need help restructuring their loans, who are in default, and servicing people who actually are trying but have, because of the rest of our economy, are having issues actually paying back their debt. The incentives change when you have a for-profit, or when you change the incentive from a for-profit institution who's in this gig to make money into a public institution that's here to provide a public service and to advance the public good. We could transform the entire system and situation of student debt. And I'm sorry for running over on actually how that might work, but we can get some more of that in the questions because I just want to make sure we're not taking up too much time here. Yeah.
It's very important to hear from the point of view of our younger citizens and students. And now to hear about renewable energy and how this might tie into this topic, Amanda Bybee is co-owner and Director of Strategic Planning and Initiatives at Namaste Solar. And She worked in the solar industry since 2003, first promoting renewable energy in Austin, Texas, her home state, while at Public Citizen, then at Meridian Energy Systems before finding her home at Namaste. Amanda joined Namaste in 2006 and has held numerous roles, the business administrator, all the way to human resources and sales and design. So let's welcome Amanda.
Thank you, Dennis. So as he said, Namaste Solar was founded in 2005. We're celebrating our 10th anniversary this year. And we are a photovoltaic installer. We design, install, and maintain solar PV systems for homes, businesses, nonprofits, and governmental entities. I was an early member of the team back in 2006 when Xcel Energy was first launching its incentive program. So I've been here through all the crazy ups and downs growth of the solar industry in Colorado. Today my focus is on strategic planning and special projects that will benefit the company and our customers. But I want to say a little bit more about what Namaste Solar is. We are also an employee-owned cooperative and a certified B Corp. How many of you are familiar with B Corps? It's a pretty good percentage, that's great. Our mission is threefold. It's to propagate the responsible use of solar energy. Key word for me, at least, is responsible, because I think there are a lot of people who've gotten into our earth-saving industry with dollar signs in their eyes, and who maybe aren't as dedicated to responsible design practices. Second part is to pioneer conscientious business practices. And this is a huge part of why many of us are at the company. And the third pillar is to create holistic wealth for ourselves and our community. So I think that Namaste Solar tries to do so much of what I perceive we're all interested in here today, and that is to use our dollars or our power as a business in the community to benefit more than just the shareholder. As Roshan was just saying, so many corporations believe that they exist for one purpose. Namaste Solar, as a certified B Corp, believes that we exist to serve a list of stakeholders, not just shareholders. And those stakeholders, which is lined out in our articles of incorporation, includes the employees, our customers, our vendors, the community, and the environment. So when we, as a business, make decisions, it's with regard to all of those interests. And we don't believe that they necessarily have to be at odds. So yes, certainly there will be decisions that benefit some groups more than others, but we try to keep a sort of mental balance to ensure that we're not overlooking the needs of one or the interests of one all the time. So when I think about the need for financing for solar PV systems, it's worth noting a little bit of the history of solar in Colorado. In the beginning, when the Xcel's incentive program got off the ground, what you found was a whole lot of people financing solar from cash or taking out home equity lines of credit or second mortgages on their homes. And that was excellent. We saw a lot of growth. The solar industry as a whole, I would say, has grown so much faster than anyone ever thought it would. Then in 2008, 2009, of course, credit became harder to come by. And we were very fortunate at the time to have something called Property Assessed Clean Energy Programs, a PACE program, particularly in Boulder County, that helped people finance solar by taking out a loan that was repaid through their property taxes on their homes. It was a very interesting program that unfortunately also got shut down by Fannie Mae and Freddie Mac, who refused to finance homes that had these loans on them because they were in primary position. And so they were worried about their repayment in the event of default. And then also in 2009, we started to see the rise of third-party ownership structures where you had a totally separate entity own the solar PV on your home that you paid a monthly fee to for that electricity. And that was also a really instrumental mechanism for continuing to grow the solar industry in our state. Today, all of those options still exist except for PACE. PACE is still on hold. You have seen a bit of a resurgence of it in certain states, particularly for commercial loans that finance energy efficiency and renewable energy projects. But I thought I would spend just a little bit of time talking about what is available, with preference being given to ways that we keep money local, ways that we empower our dollars to have a bigger impact. So I think the first way to think of it is there's the company that you work with to install your solar, who designs and installs it, and who, for most people, is the primary point of contact. And then there's who provides the funding for that. So today, there are still a number of local Colorado installers, and there are a number of local institutions, credit unions. Elevations Credit Union has a big program that serves both Denver and Boulder counties. And that's part of the requirement for participating in the program that Elevation sponsors is also an emphasis on energy efficiency, which we certainly promote. If solar is your dessert, efficiency should be your vegetables, and really what you should eat first, even though solar maybe is a little sexier than efficiency. You know, we see a number of people who work through their local banks, you know, that good old-fashioned home equity lines of credit is still, for many people, the most affordable way to get a solar loan. And interestingly, though we did see an increase in third-party financing mechanisms in 2009 through, I would say, 2012, maybe 2013, the pendulum has swung backwards. And now we're back with people taking out loans for their solar PV systems, because that does actually provide a much better long-term savings to the homeowner. You know, I think that there is a lot of advantages to these programs that you can get through your local institutions. There's a lot of flexibility on who you work with, as in which company you work with, and there's a lot of flexibility with what products you use. When you start working with some of the national banks that provide solar loans, and there are some very good loan terms out there through groups like EnerBank or Green Sky, they are a little bit more restrictive in the types of products that you can use and in the solar installers that you can work with. So this I put into a second tier of preference, where you can still work with a local solar company, but maybe they have a relationship with a national financier. And I think it's harder to know the motives of a national group. It's not to say that they're necessarily bad, it's just harder to know. Like I said, you can get really good terms. And so a lot of folks are pursuing 12-year loans with very low interest rates, as low as 1.99%. And this is a good thing in our estimation, because it's enabling people to get solar on their homes. Is it as good as working with a local credit union? No, but it's still a good thing, because we're coming at this from a perspective of more solar is better. And then sort of the third tier is that you can work with national companies who have a local office and a local presence, and they have a national financier. Again, I think it's clear that when you're working with national groups, you're not going to get the same concentration of economic benefit in your local community, but more solar is good solar. So that, you know, those options do exist. You know, it's, when I think about the need for public banking in the renewable energy sector, it is because we believe in doing as much as we can to keep benefit in our communities. And Namaste Solar is working on an initiative that sort of lines up with all of this. We're not quite to a point in its progress that we're ready to talk about it publicly, but I hope to be able to share news about it with you all in the coming months through the contact lists and things that already exist. So I wish I could say more, but it's coming.
Okay.
Thank you.
Amanda, thank you, and we'll look forward to hearing more from you as time goes on. And now, from the family farm perspective, we're pleased to have Mike Krause, founding director of the, wait a second, wait, I've got August Miller here. I'm sorry, I've got number 3 right next to him. August Miller, co-founder and director of Food Shed Productions, a social enterprise focused on public education in food production and environmental stewardship, and he's looking to urban environments for land. And we have an example of this up in my neighborhood at 44th and Umatilla, next to the Common Grounds Coffee House. One of my students from Regis, Lisa Rogers, has opened a little market right next door to the coffee shop, and it is a thriving operation. I look forward to every Saturday in the spring and summer going down there to participate, and it's wonderful. And also, while there are many opportunities that public assistance exists, the pairing of conventional banks leaves this social enterprise adrift. And August has a BA in environmental design from CU right here in Colorado, and an MA in service leadership and managed from SIT Graduate Institute. I'll let him tell you what the SIT means. And August is not only inspired to serve, but his decisions are founded on making a cultural impact. So let's welcome August.
Thank you, Dennis. SIT is an acronym that has outused its livelihood. It once stood for School for International Training and was a Peace Corps training center back when the Peace Corps was just founded. It's located in Vermont. So I wanted to start off by talking about kind of the common knowledge that we have about local farms and local farmers specifically. So what you should know about our state of farms. So there's been a decline in the number of farmers that are out there. So we are now at 58.3 is the average age of our farmers. The next 15 to 20 years, we're going to see a lot of those farmers enter retirement. So there is going to be an obvious demand for having more people with those expertise and skills out there so we can feed our nation. The second piece that we should be more aware of is the decline in arable land. In Colorado, from 92 to 2006, we lost 2.89 million acres of arable farmland. And that was not lost to necessarily the big banks, but through them, the developers. I think we've all seen how the sprawl has just gone beyond our imagination here. And that's some of the prime land that we had to grow food on. So we're pushing our farms further and further away from us. Yet the obvious source where they're going to get their income is here in these urban centers. And the next thing, I want to take a show of hands as to what you believe the farm worker median income to be. All right, we're going to start at 20,000 or more. Anyone in the room believe a farm worker makes 20,000 or more? 20,000 or more. Per year? Per year.
Is this the only source of income? This isn't a farmer who has a job in the city.
This is, yeah, single source of income from farm-related work. 20,000 or more. Okay. Or more.
Is this the top end of our range?
20,000.
Yes. $10,000 to $20,000. All right. That's fair. That's fair. You can change your vote. $5,000 to $10,000 annual income. And $2,000 to $5,000 annual income.
I thought there were mostly just large farmers now.
We'll get to that.
By the,
All right. So, to quote the National Agriculture Workers Survey, this is from 2010, farm workers in the United States have a low individual income from farm work. The median income was between $2,500 and $5,000, with 3/4 earning less than $10,000 annually. Yeah, it's interesting, huh?
Go to college on that money.
Farm work? I'm about to. So 3/5 of our farm workers, their households are in poverty today. So our experience, and this is something that my wife and I went through. We worked 40 to 60 hours per week on the farm. That's par for the course. It's not unheard of. We lived 7 in a trailer. We survived on seconds and thirds from the farm. Does anyone know what a second or third is? For those of you who don't, that is unsellable food that has mold, cracks, or is deformed in some way that one wouldn't normally be accustomed to in a store. We had a stipend of $80 per week. That is, for a year, $4,000 per year income. No insurance was provided. We were subcontracted out. So we paid taxes on that. So there's an obvious sacrifice. Seeing family, friends. My wife is French, so travel to France on the combined income there was interesting. We paid loans on my student loans. And to achieve a serviceable loan, we paid off one of those with all of our savings so that we could continue to pay loans. The monetary sacrifice, $80 a week, food, board, okay, it's enough to live. It's not enough to save. It's not enough to generate capital to start a farm. So obviously something's got to give. So after several years of farming for other people, we wanted to start farming for ourselves. Seems like a logical progression for a life choice. So one of the things that's very common among farm workers is they always see the potential that a farm has. And it's inevitable. You see where the gaps are, where things could be better, and you learn an incredible amount. You feel you can do it a lot better. All with the humility that you've learned from 5 generations before you, or first-time farmers who've never had an experience doing this themselves. Really quite heroic people who've made the sacrifice themselves. And to give you an idea of where our farms are currently, 75% of farm sales are less than $50,000 annually, and that's 2012. So we went to our community bank, and we wanted to, of course, find land in an urban setting, a place that was more protected from the chemical drift, a place where we wouldn't have to go far to the market. And the bank said to us, well, your income level puts our bank at too much risk. And then the last little clincher was, get a job. So to conclude, yes, our farm workers are aging and potentially aging out. The older generation is in decline. That's natural. But to give you another statistic, this is from the Southeast. Organic farms hired more full-time and part-time workers on average, with mean hiring rates of 60 to 26 workers respectively compared to their conventional counterparts of mean hiring rates of 23 or 12, respectively, full-time and part-time. So if we don't recognize that we actually have a surplus of young farmers without land or access to land, who is going to? This is a serious question. Who's going to recognize that we actually have the people with the knowledge, the skills, the know-how to get the job done, to keep feeding us, but our financial institutions don't? Of our friends that we've made on these farms, working together, long hours, day after day, living together, learning from each other, most of these people are leaving Colorado, and that should be a question. Why are they leaving Colorado? What is unattractive about living here? A lot of that has to do with the land value versus its land use. Can the land use, producing vegetables, sustain even the mortgage on the land? Are the codes, the regulations, prohibitive to building a simple infrastructure or having facilities to, having bathrooms? So there's quite a few obstacles. And what I'd like to leave you with is simply, what options do we have? Right, just a question. Where do we go? And how do we take care of ourselves and each other? Thank you.
Well, that was a very riveting testimony, and I got so engrossed I forgot to enforce the time limit. But you did very well, August. And now we're going to Michael O'Neill, Chief Compliance Officer with the Colorado National Bank, a community bank here in Denver, Colorado owned and operated. He's an operations and compliance executive for over 20 years, and you'll hear it in his speech pattern. He's not born in Colorado. He's originally from Georgia. And he has the background as a banker, an examiner, and a consultant with the Federal Reserve Bank here in Denver, with focus on remediation of troubled compliance programs after enforcement actions are issued by federal and state regulators. Let's welcome Michael.
Thank you, Dennis. I'm going to use some bad language in this group. So yes, I am a banker. I am a former Federal Reserve employee, executive there, but I'm a recovering Federal Reserve. And if you know anything about compliance, 12 steps was just not enough for our group. We have 37. So it's sort of the play that I want to let you know about in the community banking industry. Everybody's heard the term that the tax structure and the IRS tax codes is just limitless. And would you agree with that statement? All right, well, just to give you an idea, in the financial industry, our regulations are twice as big as the IRS tax code. There's over 60,000 pages of written text that we have to decipher as an industry, and we have federal regulators which have the money that enforce those regulations. And as part of the downturn in the economy in 2007, we came about with some new regulatory controls. The Wall Street Reform Act, or also referred to as the Dodd-Frank Act. And some of these codes were very good, and they were put into place for a reason, because some of the gambling that was going on and the bailouts that had to happen, we wanted the the government wanted to make sure they did that. But some of the unexpected consequences of Dodd-Frank and regulatory reform are additional regulatory requirements that community banks, credit unions have to follow now, that we have to get into. Just to give you an idea, last year alone, there were 17,000 pages in new regulatory requirements that community financial institutions had to sift through and figure out how to come about and comply with that. Additionally, when we sit here and we talk about it, I'm going to talk today about how the regulatory environment affects home mortgages and mortgages to our communities. With that, I'd just like to share a story with you that I have at one of my former employers. We had a small farm over on the western slope. They had a large loan, agricultural loan with our institution, had never missed a payment, had never, ever not repaid us in 25 years of borrowing with the financial institution. Our federal regulator came in and they have a new way that we calculate called global cash flow analysis that they came up with, which is different than what we used to look for repayment models. Well, because it didn't meet the new criteria, we had to call the loan based on the regulator telling us that loan's never going to be repaid. It's impaired now. You must now lower that loan as a repayment possibility, the risk of repayment. This in turn takes money out of our capital accounts where we'll get into capital a little bit here in a little bit, but we have to put it in a provisional credit account. Because if the loan does go south, it's the bank's responsibility to actually cover that bad debt. It doesn't go out to the public. The bank has to do it. But we have to pull into our capital levels, which when we're looking at capital, now all banks have to be well capitalized. Now, while there's something out there called prompt corrective action that tells you can sort of go down a little bit, but the regulators have been so focused on where capital levels are and credit criteria that it has actually pulled back money because we're having to put more money to look at capital. We're having to do our provision for loan loss. We're having to provide there. These are funds that we would have available to loan in the local community that no longer are available loan based on regulatory requirements that we're having to fulfill. When I was with Continuity Control, it's a technology company out of New Haven, Connecticut, we worked in partnership with the mathematics department at Yale University, which was right across the street from the office. And we came up with something, and you might want to go look at this. It's called the Bank Compliance Index, the BCI. You can find it, you can Google it, it's going to come up within the first one or two items that you're going to look at. It is the first index that's ever been invented that shows how much it costs to comply with the federal regulations. Now, I told you last year that, now, just so you know, this has been in the Wall Street Journal, CNBC, all the major players have covered it. The company owner has been and testified in front of the Senate Banking Commission in Washington to let them know how much it is. So at an average community financial institution, now we're talking about these huge banks out here that are trillions of dollars. What do you think the size the average community financial bank is, or credit union? It's about $400 million in assets. Okay, so we're not talking $1 billion here. We're certainly not talking Wells, which is well over $1 trillion in asset size. Okay, we're talking very, still huge numbers. In anybody's book, I'd love to have $400 million. I don't yet, but I'm working on that. Anyway, my point is, it's small institutions. Last year alone, it cost those on average $120,000 just to comply with the new rules, not the old rules that we're responsible for anyway. So with that, once again, these are funds that are taken out of the ability to go. And guess where that cost is passed on to? It's passed on to the consumer or the customer of the bank. You can't, sure, you can swallow small amounts of increases in costs, but major increases in costs such as that. So I'm going to try to wrap up so we have plenty of time for questions and answers here. I just want to leave you with this thought. While regulatory reform has done some good, in other aspects, it has actually taken money available to the community out of the banks, whether it's a private or public bank, It's taken that money away. Now, not a public bank. I mean, when I say that, publicly traded bank. My bank happens to be privately owned. Here in Colorado, there are about, I don't know, there's 75 of us that are the stockholders of the bank. But with that, what we're looking at is a public banking institution might have the ability to send some of that capital that we're having to retain based on the regulatory requirements, because I'm going to tell you, I watched my boss write a check for $1 million at the very end of the year so that we would be above a certain capital level so our regulator would not be bothering us. So there was money that would have gone somewhere else. So when you're thinking about this, while regulatory reform is good in some factors, some of the crazy things, including the invention of the Consumer Financial Protection Agency that Dodd-Frank said it will only affect institutions $50 billion or more, I can assure you it cost us last year because they changed all the rules. The other thing is, the fun part of it is, because Dodd-Frank is very specific on when these rules have to be proclamated into the public forum, that the problem is that they're passing the rules and telling us we have to do this, and then they go back and change their minds 4 or 5 times because they really didn't think through the regulation that well. So to give you an idea, I'll just throw this out to you to let you have some good numbers. 2011, RESPA, the Real Estate Settlements Protection Act. Okay, this is what is involved in dealing with home loans. We changed one form. As an industry, community financial institutions, about 16,000 institutions, it cost $289 million to introduce a new form into the environment. Well, guess what they did? As of August 15th of this year, they're changing the form again because it just didn't seem right. And it's like 3 changes to it, but it's going to cost us just as much again. So when you think the banks are sitting here complaining about too much regulatory oversight, I can assure you from the derivative side, those sort of things, the trading desk, I absolutely agree with some of those. But some of the reforms have truly impacted our local communities, and we can't get the money out to people like we want to, because if we did, the regulators would come in and they'd issue us information to where we would have to comply anyway. Thank you very much. Have a great day.
Well, that was great, Michael, and we appreciate your being here and giving us your perspective. Now, in a spirit of getting to know you, getting to know all about you, and developing community, I noticed in the last session, I don't remember that everybody introduced themselves when they asked their question. So please, dear friends, number 1, speak up so we can hear. You all need my speech course up there at Regis. But speak up so we can hear the question, and secondly, give your name and your organization or what your point of view is so that we can all get to know each other. So let's start right over here with this courageous person who stood up first. Thanks.
I'm here because I'm working with an organization called Resource Generation, and we're interested in ways of leveraging financial resources to improve the welfare of everybody. My question is for Michael. I was researching, or I read one book by Professor Anna Admati and a German colleague of hers called The Banker's New Clothes about the Wall Street crisis. And the thesis of the book was that capital requirements have been too low, and that banks can lend a whole lot using money that they borrowed instead of money that they as part of the equity of the bank. And she said that was one of the myths, is that it's expensive to have higher capital requirements, and that's one of the myths that the big bankers, the big 6, promote in Washington. And then what I heard you say seemed to run contrary to that, where you were saying it is actually too expensive to hold equity. So I was wondering if you could talk about that.
I didn't mean to give the impression that it's too expensive to hold equity. We have requirement, as I remind people for compliance purposes, as a institution, we enter into a highly regulated industry. And there's barriers to entry, and that is, and a large part of that is A, the cost to come in, and B, the regulatory requirements. And as an institution, we automatically agree to follow the current laws and regulations that are on the books. So we have no choice, well, we have a choice, but the consequences for taking other choices would be detrimental to the institution. That we're required to hold certain amount of capitals under federal law. And that sometimes is tied to international law, which as in Basel III. So that's going to be some new regulatory requirements that the big banks have to do. I work at a very small community financial institution, so I am not employee number 337,256 at Wells Fargo. But I can tell you that while there are different levels of capital, our regulators really want to see us well capitalized because so many institutions had let their capital levels go down, and then when loans went south and there's no real income, i.e. interest income coming into the bank or investment income coming into the bank, we start to have to eat into that capital, and it creates a death spiral because you don't have income coming in, you still have to pay employees, you still have to pay your light bill, you still have to pay your taxes, but this is what happens to your capital, and it goes like this. And I was actually part of a workout team of at a $1 billion bank here in Colorado that failed. I was not part of it. I was asked to come in and try to help save it. And unfortunately, we could not. And it was because the regulator was so aggressive with us. We couldn't even make new loans to start, even at their current, getting better credit, that we couldn't even make new loans to try to make that interest income to come in. So I'm hoping that answers your question. I can't really answer it from the Big Six side, but I can tell you it is something, if we could look at capital levels a little bit differently, we might be able to put that money to work in other investments. But you're absolutely right. You can't loan against the capital. You can't go against that. It just if you can think about it, it basically sits there and does nothing unless you have it invested. And there's not too many investments now for small community banks to get into that have great return. So we have to be very careful with it, and it's not allowed to be put into crazy stuff. So.
My name is Marion. I'm actually August's wife and co-founder of Food Shed Productions. I have a question about movement. It seems that we can't really wait for any decision to be done from the top. So we need to start from the bottom and grassroots movements. So I'm curious to hear if there's any initiative or any coalition of banks, for example, to change things around. And also I'm interested in your organizing and what you guys are doing as far as student debts. Thank you.
As my colleague stated, there's a lot of things that if you change anything in banking, it makes things way harder. And in terms of what that means for a movement, it means that it's really, really complicated, and it's really hard to pick a target and bring pressure, specifically that's not going to have consequences on other things. That if you change this, then there's a lot of ripple effects. The student debt. The anti-student debt movement has a lot of challenges to face. And it's really hard to build because it's this kind of abstract thing that it's just hard to kind of get your head around anyway. But what I'll say is that there is a sort of coalition of a couple different groups. I highly recommend that you look into what a group called Jobs with Justice is doing. And they are partnered with another group called the United States Student Association in a campaign called the Debt-Free Future. And they are basically working to hold Sallie Mae and other private lenders accountable for their failings and for basically screwing students in a lot of ways. And I know that here in Colorado, Jobs Justice is going to soon be starting what's called a debtors table, where they're basically bringing together stakeholders to try to push different kinds of regulations on for-profit colleges, on private lenders, that will at least make them less abusive to students. But really, the change needs to come at the federal level because there is basically, it's too expensive to go to school, and that's just the fact of the matter. And in lots of ways, some of the big policy solutions are, I mean, there's things you can do to organize movements basically all you can do is bring pressure on federal level policymakers to do smart things. And with the conditions that Wall Street has, and with the kind of like, we are way outgunned in terms of how much lobbying money is spent on behalf of financial institutions to keep things the way they are versus the way that we want, the kind of energy we can exert to make things happen. But let it be known that the federal government already spends just about $1 billion shy, which is a pittance in the real scheme of things when you come to federal spending, is just about $1 billion shy already in how much it spends on education funding, on scholarships, on tuition assistance to poor folks, that if it just reconfigured the way that it actually spends its current money in financial aid nationally, we would be most of the way to actually paying for every person who's of college age to get 4 years of education tuition free. It's the money's there. We are not broke as a country. We're one of the largest, financial powers in the history of our world, and it's just a matter of finding the political will to do it. But in terms of actually being part of a movement that's pushing back against these issues, Jobs with Justice in the United States Student Association are a couple of the groups that are doing the best work. The Debt Free Future campaign is really awesome, and Senator Elizabeth Warren is one of the big backers of. They are in constant conversation with her. A lot of the things she's doing are about sort of rechanging and retooling the finance and the interest rates on student loans, which is only a partial solution. I don't want to pay lower interest on my crushing debt. I want my crushing debt off of my back.
Yeah. My name is Marcia Miller, and I recognize many of your faces because I'm also a grassroots worker along with many of you, and so I'm part of many organizations. And so my question, I guess, or I just have a comment that I don't think was, well, of course it's not mentioned, but that public banks reflect the values of their people. And I mean, obviously from the panelists, we're representing the environment and sustainability, but those are not, they're not actually, they're not direct achievements that North Dakota Bank it was not listed, but it's obvious that public banks are concerned about our future and sustainability, which is what what the public represents. So I think that's an important point to be made about, and also it speaks to strategy when you're going to try to create a public bank and how to talk to people, because, so I won't go into that now, but I'm hoping to hear from the panelists this afternoon how they see strategizing to speak to people about the need for a public bank. And one of my questions really has to do with, for you, August. I've heard that only 2% of the arable land that's in farming in Colorado is actually producing food that people eat. Is that correct?
I wish I could say that was or wasn't.
Okay.
I don't know.
It was a fact when we were pushing for the local food production, backyard animals ordinance in Denver. That was one of our facts that we found. So can you talk about agribusiness and how many farms are actually owned by local farmers versus corporations?
Yeah.
And why it's important?
I'll do my best. I think in terms of organic versus conventional, monocropping, or diverse vegetable production, you really have your gamut of players. And these can be both good actors and bad actors in both organic or conventional productions. Just because it's certified organic doesn't mean it has a lot of nasty chemicals on it that made that quote-unquote national list. You can look that up. There's some pretty interesting chemicals that you would want protection for. But as far as, I'm forgetting the question, I'm sorry.
The private or the individual versus corporation-owned farms.
I think there are a growing number of locally owned, non-corporate farms, and there should be a lot more, and that's what I was getting at, was we have all of these people out there that have the skills, the desire, the initiative to actually start farms, but we're not seeing that happen. And in terms of the corporate farms, we are, the average farm size in this country is 434 acres. The average time that someone spends per acre is 45 minutes for an acre of food. And these large monocroppers. And that tells you the amount of care and value the food actually has, is 45 minutes.
This is for Mr. Bliss.
And
I like your name, Mr. Bliss, and I hope we can create bliss together, okay?
Introduce yourself. Introduce yourself.
I'm Janet Lee Meisinger. I'm from Weld County.
Great.
I wanted you to know how much I paid for a semester when I was in Nebraska. University of Nebraska was $80 a semester, and my books were $40, and I worked part-time and put myself through school. And there is no reason why we should see our children be in debt like you are.
You're exactly right. Thank you.
We have to look at the educational systems themselves and how they are connected to the bankers and how they all benefit from that, okay? But we're going to get it straight if I can live long enough.
Oh, good. That's
Excellent.
great.
Thank
Very
you so much.
positive. Okay, let's go over here, and we've got about 3 minutes.
Okay, my name is Tom Abood, and I just have a couple quick comments and a question for Michael. But I think it's great we have food, energy, and finance all together, how interrelated they are. I am a Namaste client and investor. Awesome company. Food-wise, there are a group of us here in this room that have formed an investment club, and we are taking Wall Street money and putting it into local farms. And more people need to take a look at what the alternatives are out there. Student debt, what can we say? I've worked with students that have up to $500,000 in student. These are professionals coming out for medical and legal and no jobs. What are they going to do?
That's it.
My question for you is, if we have a state bank here in Colorado, what's the impact? How is that going to change your loaning, your mentality? Are you going to make loans for small farmers? Will that change the whole playing field?
I'm not sure. Once again, I'm not somebody that makes the lending decisions or that. My job is I'm the head sheriff at the financial institution, and it's my duties and responsibilities to make sure that we follow the rules and the laws as promulgated by our legislative actions and put into place by our regulatory oversight. So I'm not sure. I haven't read any of the legislation. In fact, I'm not aware of any here in Colorado that we're pushing towards that. So I'm not sure how that would interact, because it would be a state chartered bank, and I actually work for a nationally chartered bank, so I'm not sure there would be any crossover there based on the charters. So I think if it's a state-owned bank, as the North Dakota bank is, it only deals with other state chartered banks. So I would not have anything, but I think if there's something along that and there's more capital to go into the system, there means that would be more capital that's available for different types of development, whether it was lending for solar energy, for farming, for student loans. So I'm sorry, I really can't speak to that because I haven't seen it or how I don't know how it would affect the regulatory atmosphere. So sorry about that.
Hi, I'm Walt McCree from the Public Banking Institute. Great to be here. And I want to thank, the opportunities to do all the things that are before us, and we're all willing to do, just miss one thing, and that's we lack the money. That's, of course, what the public banking opportunity points out or provides. But one of the things that is a distinction, an important distinction that we're making about community banks and the global banks. And I want everybody to just make a note of it. When we think that community banks are pivotal assets to every community, and they're diminishing in size and in number around the United States. They are the front line of issuing credit into our community. And so we support them very much and are looking forward to expand and accelerate their position, their strength, so that their businesses can prosper to do what they do best, which is to know the people, issue the credit. So I want to ask about regulation. The big banks have seemed to run roughshod over their regulatory overseers. You guys seem to be really struggling, and of course at greater expense. And from what we understand, it's the big banks who are writing the regs. Is there a double standard in how regulation is being exercised in banks these days? Big banks, community banks.
As a former regulator, once again, I was not anywhere near the Fed board. So that's where those decisions are made. But from the standpoint, the Fed generally writes, the regulator generally writes the rules because the rules are written based on legislation passed and signed into law. And there are certain things, and they're given out to regulators, whether it's federal or state, that have to do that. I believe that, as we all know, there is input from the public, and any new rule or regulation that comes out includes all that input. Now, how much input is put into that from, the private sector? And how much influence, I'm not privy to that, so I'm not
like
able
your
to
smile, though, Michael. It seems to be revealing. It's true.
I'm just a happy-go-lucky Irishman, so I smile a lot.
We got to get going there, friends. You can talk about it later.
Yeah.
And right over here, let's.
Thank you.
Hi, thank you. My name is Charlene, Sharlene, and my last name is Holt, Holt. And my project is called Musicians for the number 4 freedom.com. And I have these little tiny green things that are floating around, okay? And I'm a student currently at the University of Colorado at Denver in film and television and video. And I've been doing activism about 5 years. And I appreciate all of you coming out, and I want to mention that Ellen Brown is a featured activist at my website. And at my website I have featured activists, I have featured filmmakers, featured musicians, and featured artists. And ultimately, I'd love to have some sort of an annual awards ceremony here centered in Denver, where we can give awards every year to the best activist artists, the best activist filmmakers, and the best activist musicians. And so, real quickly, I just want to say that the types of articles that I have at my website are Ben Bernanke and the Wisdom of Parasites. I have see the sugar bowl, do the Tootsie Roll with the big bad yellow devil's food cake. That's the good ship lollipop. And so I have those types of articles that really transcend the verbiage and kind of go to the right-brained and kind of, I look at movies like All of Me, Steve Martin. I look at movies and analyze how the movies in Hollywood are telling us what's going on with our system if we just look at them. And that's what I do at my website also. So thank you so much.
And thank you. And we, in Denver, we passed, the city council passed a law that you can have up to 4 chickens in the yard. Anyone here have chickens? It's a great event. But the marijuana people who are selling marijuana here in Denver, legally, of course, have noticed that you can have chickens in the yard next door to the marijuana plants. So then the reason they want to have this is so they can advertise pot in every chicken. Now, I told that at Regis University the other day, and not one student laughed. So let's take a look. We'll come back in 10 minutes and see you then. Thank our panel. They were wonderful.